We are on day number 8 of BNB Binance coin. Follow me. We got triggered into a short trade. We've exited half of our unit. We're risk free. So now we're going to talk about how do you manage the second half of the position? How can we use Fibonacci time retracements to give us a big clue on how the correction will tend to occur? And also we're going to zoom out on what are we anticipating over the coming maybe 1 or 2 weeks, maybe 1 week thereabouts, before we're really going to make any big decisions. So if you like today's content, like, subscribe, hit the bell notification. If you don't know me by now, my name is Chigir. I'm the award-winning author of The Extraordinary New Venture Capital Opportunity, How to Invest Like a Pro, featured in the best-selling book, High Probability Trading Strategies, back in 2008. We're only used to focus on currencies, but now exclusive on cryptocurrency. So let's dive straight in. All right, so we've been following BNB. So the other day we did a video. It said BNB trade entered, Binance coin playing out just as expected. Find out how to get risk-free. So we got risk-free yesterday, risk-free. So what we said, in fact, let's just go straight to the live chart. What we said yesterday, in fact, I'll show you in the video just what we said, and then we'll go into our live chart, is we entered down here. We saw this opportunity. We said go short. Stop loss originally was over here. This is our stop loss. So our capital exposure is this amount. That should represent 3%. And then once the market got triggered in and started to move to the downside and made these patterns, we moved our stop loss to break even. But we also said, and we'll cover it in more depth in a second, that the market looks like is making a nice clean 1, 2, 3, 4, 5 of an initial move down. So for half of our position, let's put our stop loss on half our position over here. Let's lock in some profits, and the remainder of our profits is risk-free, right? And we're going to cover that in a bit more depth. And so let's just jump straight into the live chart so it's really clear. Just in case you haven't been following the last 8 days. So today we're at day 8. We're literally following this day by day. Probabilities, never certainties. We don't know what's going to happen, but we can just do high probability analysis and a look at what does actually happen. So again, just to reiterate, because it's good practice, right? You'll see this same on a weekly chart and a daily chart. Daily chart and an hourly chart is what we're focused on right now because of the short-term movements. Is, again, we had reason to believe this was going to be the top. So we said, okay, if this is the top, that means the market should not go higher than this point. If that is the case, let me just change this to a black line. Make it really clear. The market should not go above this point. If that's the case, can we have a shorting opportunity? What we said was, okay, if the market goes below this point over here, which it did, that's a signal to say this top is likely to hold. Then we're going to wait for the first pullback, which we got, which was this. And then at this stage, what we said, if you go back, it's around 2 days ago when we're doing the Follow Me BNB, we said, okay, if the market then goes below this point, we'll put a stop loss above here and we'll trigger into a short trade. Short trade meaning making money whilst the market is going down, right? Then the next day, what happened? We got triggered into the trade, right? So that's where we are today. Let's get rid of those. So now let's just manage this position. Let me just get rid of these lines as well. Get rid. Okay, great. Okay, brilliant. All right, so then, as we said yesterday, this is an hourly chart. So we're looking at hourly chart. So this is almost, what this is. Because sometimes if you're not used to charts, to get the context, top left hand, top right hand corner is our weekly chart. So what we're really measuring is, I'm just going to show you this. And there's a reason. What we're measuring so you can see clearly is on a daily chart, it's 1, 2, 3. We're on the 4th day, right? It's 4 days of data. And then when we go onto an hourly chart, what we're looking at is this on the hourly. If I can pull it out. There we go. All right, so that's 4 days worth of data over here. Right, that's what we're looking at. All right, so now let's get focused because we're going to talk about numbers today. Some people love numbers, some people hate numbers, but it's hard to avoid numbers when you're trading. You want to have clear numbers. So let's look at this. We got triggered over here, as in over here. The market's moved down. And what we said the other day, it looks like it's forming a 5-wave sequence to the downside. Let's just make it nice and thick over here. 5-wave sequence to the downside. And we had reason to believe, taking Fibonacci ratios into account, that's what these lines over here, I can get rid of them now. That's what this pink box was as well. We can get rid of this as well. We had reason to believe that we're coming towards the end of a five-way sequence to the downside. Now, this is really, really important. We're going to zoom out for a second and stick with me on this because this will be a valuable lesson. We're going to zoom out for a second because we've got two outcomes that we're looking for. We're looking at, right, let's take some profits just in case we're wrong. So we're risk-free and we protect our gains. But two, what's our expectation based on the pattern position? So I'm just going to zoom out. This is still on the hourly chart. So zoom out so we don't get too caught up because a lot of people get too caught up on the very, very, very short term. So what we're looking for is to ride this trend, this last move to the downside, and we're anticipating this. That's a relatively big move. That's like $330 to around $200. That's significant, very, very significant, especially because we've got a very tight stop loss, very, very tight, and you saw how we did that a couple of days ago. So this is what we're aiming to ride, as in the trend on the downside, for the second unit, our main position. The position that we exited is our insurance policy. It's to say, let's take some money off the table, let's get risk-free, and even if the market does the opposite of what we're expecting, we've still banked some profits. So how many times can you do that if you're banking profit when you're wrong? Well, infinitely, because you're banking profits. Whereas if you're taking a loss, then it's harder to do because you're literally giving money to the market. So you want to be risk-free or banking some profit in these cases. So this is what we've done so far. And I want to take my time on this because it's important. Like how long it takes me to do this is like 30 seconds. To explain it and the concept is going to take a little longer. So this is going to be valuable because most people don't realize this if you haven't been trading for a while. So we said, okay, short term, 1, 2, 3, 4, and it looks like a 1, 2, 3, 4, 5. So we put a stop loss over here to go, I want to exit half of my position if the market goes above this point. Right, so that's from the video yesterday. That's what we were talking about. I was live, and it was literally within a few hours. But just so you know, I don't normally trade a day-by-day chart as in an hourly chart. I'm only doing this more for the context of this content, or for this content. But this applies to a weekly and daily time frame, so you only need to look at the chart once a day, right? So I like to do weekly and daily, so you be really, really patient and wait for these setups. But the exact same principles apply whether you're trading a 5-minute chart, 15-minute chart, an hourly chart, a 4-hour chart, a daily chart, a weekly chart, whatever chart it is, the same principles apply in terms of risk management and trade setups. It's all markets, all time frames that this applies to. So let's just do some numbers, right? I'm just going to keep it simple. So let's just say you had 100 grand in your account when you're taking the position, and we're risking 3%, right? Minimum 1, maximum 5. 5 is quite aggressive. 3% is good practice. 2%, 3%, depending on your account size and your experience. So let's just go with 3%. So we go, okay, times by 3% is 3,000. So when we do our trade, and I want you to understand this. This is really, really important. Our initial risk was this much, right? Why? Because our entry was over here and our stop loss was over here. And this represents 3%. So if the market triggers us in, which it did, and sometimes this will happen, you'll get stopped out. How much do you lose? Well, you lose 3%. That's what you're risking. That's the capital exposure to find out if your analysis is right. If you're right, you make profits. If you're wrong, you lose 3%, right? That's the name of the game. And as the market went down, we don't want to leave our stop loss over here. So what we did was we moved our stop loss to break even, as in at the entry point. But on half of our position, we moved it to down here. So this is where we're going to move to our next level. So I'm just going to do this for us. We're just going to measure our entry and stop loss. So our entry position was here, just for an indicative feel for what kind of numbers we're talking about, so you get a real flavor. And we've been stopped out over here. We can see we've been stopped out, which is good. This is for a profit, this part here, if I can get this arrow. Yeah, we can see that this has gone above this line, so we've been stopped out at this point over here for half of our position. So it made roughly, I was doing this earlier, it's roughly, let's make sure I got this as tight as I can, roughly a 4 times net profit. So what does that mean? What does that mean in English when it says risk reward 4 to down here? All right, so we've risked $3,000. So our open position is $3,000. When it moves down to this point over here, that basically means times 4 plus the original capital, which is times 5, that's the running P&L at the point of this stop loss. So what we're doing is we're saying our original entry is 3,000. We're going to take half of that. Half is at risk-free, as in that entry point, stop loss, if you're familiar with stop losses. And then the other half, we've exited at a 4 times net profit. What does that mean? We've made a profit of 4, which is 6,000, and we've got our initial capital back in our pocket. So it's, oh, I put one too many zeros there, one too many zeros. So it's 7,500 is basically back in our pocket. So we've pocketed 6,000 net profit. Worst case scenario, we made 6,000. Our starting capital was 100,000 in this example, which means we've banked 6% of our total portfolio size. That's not bad for a day's work, right? 6%, that's pretty amazing. So what's next? Hopefully that made some sense, right? We might need to go over those numbers again, as in you might need to go back over the numbers just to make sure you understand those numbers. But we basically banked some good profit, which is, this represents, it's actually a 12% gain, but we've exited half. So what we've realized, actually exited, is 6%. So worst case scenario, let's just say, plays devil advocate, and the market just does this, and it stops us out in our second unit. Yes, we've given some money back to the market and got stopped out, but we've still made 6%. But why would we not exit the full position at this point? Because a lot of people are like, that's a good move. That's a big move to the downside. That's 12% in one trade. Geez, if I did that 5-10 times, in a month, that's very, very significant. So this is where we are going to focus on the second unit now. So we've got our first unit, entry done, risk management done. We've become risk-free, move your entry to stop loss, your stop loss to entry point, and we've taken some early profits. Right? It's good practice, very, very good practice. So now what we're going to do is going to manage our second position. So what is the expectations if now the market unfolds as anticipated? And that's what we're going to focus on. And I want to do it step by step so you get this, because if you can apply this consistently, it makes just a world of difference. So I'm going to stick with this chart over here. This is the hourly chart still. So what am I anticipating to happen? Right? I'm going to do some analysis in a second, but there's no real work to be done other than patience. This is now exercising patience, exercising control. Is what we anticipate is some type of wave 1. So we've got a 5-wave sequence to the downside, but a 5-wave of what? It looks like a wave 1. We're probably going to get some type of wave 2. Hopefully it doesn't stop us out, but it might do. And then we just look for another entry point if it does. A wave 2. Might get another nice wave 3 to the downside. A wave 4. And then some type of wave 5 of 5. Okay, there's quite a few degrees of counts over here because we're on an hourly time frame. There'll be 4 degrees of counts. 5 over 5 over 5 over C over 2. We don't need 5 degrees. We just happen to have 5 degrees. So what we're looking to do now is say, is it highly probable that the market is going to continue to the downside? There you go. Yes. Why? All right. Good question. So if I go to my top right, pay attention to the top right hand corner, is the daily chart. What's the momentum doing right now? It is bearish and not oversold. So that tells us we probably got 2, 3, 4 days of sideways to down on the momentum. Momentum measures the rate of change, right? So this is the momentum to the downside. Okay, we want to trade in the direction of the larger degree time frame. In this case, it's the daily chart, right? That's what we're looking at. Hopefully that makes sense. Now we're going to drop back down to the hourly chart, which is down here. And we're just going to finish up on, okay, let's just do some wave 2 analysis. You got wave 2 analysis, this wave, potential wave 2. This. When is it, how long in time, price, pattern, and momentum is it likely to end from a typical buying and selling behavior perspective? Keeping in mind that we've had a textbook 5-wave sequence to the downside, we will normally get a 3-wave, minimum of 3-wave correction. Not guaranteed, probabilities, never certainties, but that's the name of the game. But the main thing I want you to keep in mind is, why are we holding the second position? Well, we actually anticipate that is more than likely, based on an external retracement, going to go below $200 or tag at least $202. That's significant. That's very significant. How significant? Well, let's have a look. Let's have a look. I did this the other day, but I just want to get this point across because a lot of people, what I found, are not used to having tight stop losses and maybe exit the market too soon. And I go, no, it's okay to ride the waves. You want to be a surfer, find the wave, and then ride it, really, really ride it. So what will be the net profit on the second if, and it is an if, it reaches the minimum external retracement? Well, it's approximately 20 times profit. So what does that mean? What does that mean in English? So again, let's just do the math. 100,000 starting portfolio size. We risk 3% capital exposure to find out if we're right. Half we exit, which we've done already. But then the second half, the second 1,500, we're looking for a 20 times potential net profit, which is 30 grand plus the original capital back in your pocket, plus the 7,500 that's also back in our pocket. So we a total of 39,000. So we're risking 3,000. We want to get risk-free quite fast. Not in a emotional way, more in a mechanical, objective manner. We've accomplished that. If you watch the last two videos, day 7 and day 6, on the follow me on BNB, you'll see that very, very clearly. But then 39,000 gross and minus the original cost. So that's 36,000 net profit. So that's 36%. 36,000 divided by 100,000 is 36% with one trade, where we only risk 3%. Now, you seen the power of this? That's like a 12 times multiple from risk reward. Now, is it going to unfold like this? Well, quite frankly, we want to have two outcomes, two mindset things. One is, who cares? Well, obviously we care, but right now we're risk-free. So if it doesn't pan out, okay, so it's like this. It's like how I see it is, you play the game, you're wrong and you make 6%. So at this stage, if we're wrong, we make 6%. If we're right, we make around 36% for your whole portfolio, not for the position size. Position size is like a 22x or a 20, whatever it is, right? 22x. 22x. Yeah, I don't know, let's just make sure we got the numbers right. 36,000 net profit divided by 3,000. 12x. Make a 12 times multiple on your risk reward. But right now, we don't want to get hung up on that. What we want to do is stay in the moment, stay in the art of this moment to go, what do we have control over right now? Right, it's just our knowledge on reading the market. So now let's just finish up on, we've got this 5-way sequence to the downside. So I'm going to introduce something called Fibonacci time retracements. I'm actually building a new course on this, Fibonacci time, because it's been highly requested by my community, because I do a lot of Fibonacci time, but sometimes it's a bit complicated. But we're spending hundreds of hours simplifying the heck out of it. But simply what we do is we measure how long does it take for this 5-way sequence to the downside to unfold. And then most corrections. So what we've done is we basically measured from how long did it take this to unfold. So we've measured this, and we're going to project forward two key ratios. The first ratio is 38.2%. This is typically the minimum for a wave 2 correction. And then the typical maximum is 62%. That's what these two lines are, right? This is important. So now we've got some time. How long should it take? Well, we can see that this market has moved up, but it hasn't moved up in this time. So we're probably going to get one more leg to the upside. Yeah. So from a pattern perspective, we should always anticipate 3 legs. Is it going to have 3 legs? I can't tell you. But that's what we should anticipate. All right. So that's what we're looking for. That's highly probable. Is it guaranteed? No. Is it highly probable? Yes. Now let's just do some Fibonacci price. All right. So we're going to do this high to this low, and we're going to take a couple of ratios, the typical retracement zones. Most corrections will occur between the 50 to 62% and the typical maximum of 78.6%. Now, if it goes to the typical maximum, we will get stopped out, but then we just look for another entry point. However, most will kind of go into this range over here. Also, last but not least, let's just do 1 over Fibonacci time. We're going to measure how long did it take for this wave A to form, and then the wave C projected from wave B. I'm doing a new course to this. I'll have a masterclass for this as well. It's not out yet, but typical is 100 to 1.618, right? So we can see we're at the typical maximum time. There's another one as well that I'm going to do. Just bear with me. Over here. So it's likely, is it going to pop up? We don't know. But we'll see. We'll see. But it's really this zone over here. If it reaches this zone, what we're anticipating is that the market is going to move to the downside and continue to trend on the downside. If the market goes below here or below here, that will confirm it. We might have a short, this might be the ABC, but more often than not, it'll reach a minimum 38.2% time retracement and a minimum of 50%. On a strong bearish trend, 38.2 is relevant. So it has almost tagged that, but more often than not is the 50%. But we're in this trade, so I'm not looking for an extra entry position right now. What I'm looking for is, why am I holding the second unit? Well, what I'm doing is, I'm going to just go back to a daily chart, and then we're going to wrap up. This daily chart, it kind of helps you now put things into perspective. Because now with the daily, in fact, let me just zoom in like this. I'm just going to, actually I'll leave, I'm just going to quickly remove these off the daily chart. You can keep it on the hourly chart. And same here as well. I'm going to leave it off the daily chart. There we go. All right, so now this gives us nice perspective. If we just look at this, what we're looking for is we've got this nice entry on the downside on the daily. We're looking for a little pullback before a continuation to the downside. The momentum is still bearish. We can see that really, really, really clearly. So there's no rush, no rush. When the momentum on the daily, which is a higher degree time frame in this case, reaches the oversold zone, then we want to be highly aware that we might be coming towards the end of this major wave 2, wave C over wave 2 in this kind of zone. We want to let the market tell us, and then there'll be pivotal points where we will trail our stop loss closer to the market, closer to this time, so we can maximize how much we make with the trend. So the trend is your friend. Ride it until its end, until it reaches its bend. So we've identified the end of this, what looks to be the case, this wave A, B, C, and we're trading this wave 5 to the downside, and we've traded the wave, what looks like to be a wave 1 of wave 5. We're waiting for 2 of wave 5, and now we're waiting for wave 3 of wave 5 to unfold. If a wave 3 of wave 5 unfolds, that can be quite impulsive to the downside, which is good if you're shorting. If you're shorting this position, and that's what we're focused on right now. And then there you have it. So what we covered today was a lot. It was a lot. We covered the numbers. We talked about risk management, risking 3%, how to manage half with an initial stop loss to get risk-free, lock in some profits, and then the second half of your position to really ride the trend. We use Fibonacci time, price, momentum, and we're using Elliott wave patterns. And when all 4 of those coincide, it's really, really high probability setup. So it's logical, mechanical, and non-emotional. So if you want to learn how to do Elliott waves, Fibonacci, I've got a free masterclass. It looks like this. It's in the link below. If you click on it, it'll take you to this page. Elliott wave Fibonacci masterclass. I covered the 3 key rules, and it's literally what we're applying in this Binance coin BNB. Follow me in the last 8 days. We're literally just being patient, really, really patient. And I'm actually really being patient for the further move to the downside for a potential larger degree end of a correction. And then we want to look, can we have a signal to ride the trend on the upside if it unfolds that way, but we're going to wait for signals. It's like we're waiting for a car, we're behind the car, and we're waiting for it to put on the indicator before we go, okay, it looks like it's going to turn. But still, we don't actually jump ahead of that. We just go, let's wait for it to begin to turn, and then look for a logical, high probability entry point with a logical stop loss where the market shouldn't go if we are correct. But what do we need to risk? What's the capital exposure? Well, it's 3% of your account size. If you're right, we make 6 to 30 or 6 to 36%, like we saw. If we're wrong, we lose 3% or we break even or we just make a small profit. How cool is that? So that was detailed. That was a big one today. You might want to watch that one again because this is what applies to all markets and all time frames, and we're just repeating it over and over and over again. So if you like today's content, like, subscribe, hit the bell notification. Let's finish on a quote. I like this quote. It's one of these hard lesson kind of quotes, but it's true. It's really, really true. It's Benjamin Franklin. He or she who is good for making excuses is seldom good for anything else. He or she who is good for making excuses is seldom good for anything else. Now, in this world, what I notice is this thing where people point outside the window and they're kind of point and looking for the blame game. And in this game, there's angels and witches. Angels when things are good and witches when things are bad, right? Angels and witches. There's like witch hunts, which used to happen back in the day. You know, if you've read a book called Rich Dad, Poor Dad and Cash Flow Quadrant, it talks about it. And it's often the same people. There's like angels and witches and people are pointing the finger and going bump, bump, bump. So what most people don't realize is when you're pointing the finger, there's 3 fingers pointing back at you, right? And we got to look at what have we got control over. And what, from my perspective, is what we've got control over is high probability analysis, momentum, pattern, price, time. Take our time, have an entry strategy, and then know and have a vehicle to leverage those positions. So being able to short the market, going long on the market, using stop losses, etc. And whatever the outcome, we must learn, right? And often learnings, when things don't go our way, don't come for free. You have to search for the learnings. And what can we learn to get stronger? So just be careful of playing the blame game when you're pointing the finger, is to know that 3 fingers are pointing back at you and then go, what have I got control over and what can we do? So when we're doing our technical analysis, we go, look, we don't have control over the millions of buyers and sellers when it comes to BNB coin. We don't have control over it. What we have control over is understanding the psychological mood, which is basically Elliott waves, Fibonacci price, understanding the rate of change, which is momentum, and combine that with Fibonacci price and time, where we can kind of really peg stuff and then go, right, what are we willing to risk capital exposure to find out if we're right? And we have to make that business decision. If we're right, we make a profit. If we're wrong and you got good risk management, you can still make a small profit or break even, or you take a small loss. And that's the name of the game. All right, keep learning, keep training. Watch out for my Fibonacci time course. It's going to come out very, very soon. Working hard on it in the scenes. You're going to love it because I've simplified a very complex topic and I think you get massive value. But for now, you should be sharpening your axe with the Fibonacci and Elliott Wave Masterclass, where you can learn how to read the patterns of the market and combine key Fibonacci ratios, which you're seeing me apply day by day with Binance coin. Watch the last 8 days. So today is day 8. Tomorrow will be day 9. It is unfolding in a textbook fashion, which is not always the case, but it seems to be. So let's see if we get stopped out on our second position, or does the market continue to the downside and we're anticipating that wave 3 to the downside, and then we can lock in a logical manner more profit. Because if it moves to the downside, we're not going to leave our stop loss all the way up here. There's going to be a logical point where we're going to get it close to the market. Not close to the market, but closer to the market, basically in a position where the market shouldn't go if the trend should continue to the downside. So it's logical, mechanical, objective. We make a business decision where we don't need to rely on our emotion, because emotions in this game are terrible. Like, we don't want to rely on fear and greed, euphoria and depression, all of that kind of jazz. We want to go, right, we want a written trade plan and then follow those trades in a business-like manner. All right, today was a big one. So you might need to watch this one again because we covered some key points, but it's where the rubber meets the road and the things that need to come into fruition to be successful as a consistent long-term crypto trader. All right, I'll see you very soon.